So before we dive into finance, let us make sure we actually understand what quantum computing is, because it sounds intimidating, but the core idea is surprisingly intuitive. Think of a classical computer like a person walking down a long hallway, trying every single door one by one to find the unlocked one. It is methodical, reliable, but slow when the hallway has a billion doors. A quantum computer, it tries all the doors simultaneously. That is the magic. Classical computers use bits, which are either 0 or 1. Quantum computers use qubits, and here is where things get fascinating. Thanks to a property called superposition, a qubit can be both 0 and 1 at the same time. Then there is entanglement, where two qubits become linked so the state of one instantly influences the other, no matter the distance. Together, these properties allow quantum computers to process mind-bending amounts of information in parallel, making them exponentially more powerful for certain complex problems. It was a direct threat and an extraordinary opportunity arriving at the same time. Let's take a quick journey through time. Back in 1981, the legendary physicist Richard Feynman proposed a radical idea, that only a quantum system could truly simulate quantum nature. That single thought planted the seed for everything that followed. Through the 1990s and 2000s, researchers slowly built the theoretical foundations, while companies like IBM began experimenting with early quantum hardware. Then came the moment that changed everything. In October 2019, Google announced it had achieved quantum supremacy. For finance, that is not just an upgrade, that is a complete transformation. Finance is arguably one of the most data-heavy and computation-intensive industries on the entire planet. Think about what happens every single second inside a major bank. Thousands of transactions are being processed, risk models are being updated, market prices are shifting across hundreds of exchanges simultaneously. Hedge funds are running complex algorithms to find the tiniest edge in the market. Insurance companies are calculating probabilities across millions of policies in real time. Banks, hedge funds, and insurance companies collectively run millions of calculations every single second just to keep the global financial system functioning. That's not just an upgrade, that's a complete revolution in investment strategy. Imagine you're a fund manager responsible for investing billions of dollars. Your job is to find the perfect combination of assets, stocks, bonds, commodities, real estate, that maximizes returns while minimizing risk. Sounds straightforward, right? It's anything but. With thousands of assets available globally, the number of possible portfolio combinations is astronomically large. Classical computers simply cannot evaluate every single combination. Instead, they use approximations, educated shortcuts, that get close to the best answer, but never truly optimal. Here's where quantum computing changes everything. Because of superposition, a quantum computer can evaluate all possible asset combinations simultaneously, not one by one. It's a genuine competitive superpower that could redefine how banks protect themselves and their clients. To understand how exposed they are to market swings, banks use a method called Monte Carlo simulations. Imagine running thousands, sometimes millions of different market scenarios, stock crashes, interest rate spikes, currency collapses, all to figure out what could go wrong and how bad it might get. Sounds powerful, right? The problem is, running these simulations on classical computers takes enormous time and serious computing power. We're talking hours or even days for complex models. That's where quantum computing steps in and changes everything. A quantum algorithm called quantum amplitude estimation can perform these same simulations exponentially faster, not slightly faster, but on a completely different scale. What takes classical systems hours could potentially be done in seconds. The race has already quietly begun. In this world, milliseconds are not just time, they are money. Millions of dollars can be made or lost in the span of a single blink. Classical computers already operate at remarkable speeds here, but they still process information sequentially, analyzing one data stream at a time. Quantum computing changes that equation entirely. Imagine a quantum system simultaneously processing thousands of market signals, live news feeds, earnings reports, and global data streams all at once, and executing the optimal trade before any classical system even finishes reading the first line of data. That is not an incremental improvement, that is a complete revolution. Firms that gain access to quantum-powered trading systems would hold an almost unfair advantage over competitors. Now let us talk about something that affects every single person with a bank account: fraud detection and cybersecurity. Every day, banks process billions of transactions globally, and hidden within that ocean of data are fraudulent patterns that classical systems often miss until it is too late. This is where quantum machine learning becomes a game changer. By analyzing billions of data points simultaneously, quantum systems can detect suspicious transaction patterns in real time, flagging fraud before a single dollar leaves your account. But here is where things get uncomfortable. Quantum computing is a double-edged sword. The same processing power that protects your money could also be used to shatter current encryption standards. Most banking security today relies on RSA encryption, a system that would take classical computers thousands of years to crack. A sufficiently powerful quantum computer could break RSA encryption in hours. If the financial industry is not prepared, the very infrastructure protecting your savings could become dangerously vulnerable overnight. Major banks are not waiting either. They are actively investing in quantum-resistant encryption protocols before the window of vulnerability fully opens. The cybersecurity threat from quantum computing is not waiting for the future. It is already happening right now, today, as you watch this video. There is a strategy being used by sophisticated hackers called Harvest Now, Decrypt Later. Here's how it works. Cybercriminals are actively intercepting and storing encrypted financial data, bank transactions, wire transfers, personal account details, even though they cannot decrypt it yet. They are simply waiting for the day when quantum computers become powerful enough to shatter today's encryption standards like RSA and elliptic curve cryptography, which currently protect virtually all financial communications worldwide. Think about that. Your financial data could already be sitting in someone's database right now. This is precisely why institutions like the National Institute of Standards and Technology have been urgently developing post-quantum cryptography standards. Now let us talk about something that affects millions of people every single day: credit scoring and loan risk assessment. Today, when you apply for a loan, classical models evaluate a relatively limited set of variables, so your income, your credit history, maybe your debt-to-income ratio. The result is often a blunt, imperfect judgment that leaves many creditworthy people unfairly rejected. Quantum machine learning changes this entirely. These models can simultaneously analyze thousands of variables: your spending behavior, social patterns, regional economic indicators, employment trends, and far more, processing all of it with a depth and accuracy that classical systems simply cannot match. What does this mean in practice? Faster loan approvals, more personalized interest rates, and fairer decisions that reflect your actual financial reality rather than a simplified snapshot. For banks, it means dramatically lower default rates. For consumers, it means a financial system that finally sees the full picture of who you truly are. The edge here is enormous. If you have ever heard of the Black-Scholes model, you already know that pricing financial derivatives is no simple task. Options, futures, and other complex instruments require solving equations with enormous numbers of variables, probability distributions, and time-sensitive calculations that push classical computers to their absolute limits. The computational load is genuinely brutal. A single mispricing can cost trading firms millions of dollars in seconds. This is where quantum computing enters as a game changer. Quantum algorithms, particularly those built around quantum amplitude estimation, can evaluate the probability distributions underlying these instruments far more efficiently than any classical approach. The result is faster, more accurate pricing with dramatically reduced errors. In volatile markets where prices shift in milliseconds, having that level of precision gives traders an extraordinary informational advantage over competitors still relying on classical systems. This is not theoretical boardroom talk. The biggest names in global finance are already placing serious bets on quantum computing, and the investments are substantial. JP Morgan Chase has partnered directly with IBM Quantum, running real experiments in portfolio optimization and option pricing using quantum algorithms. Their researchers have published findings showing quantum approaches outperforming classical methods in specific financial calculations, proving this technology has genuine practical value today. Goldman Sachs has been developing quantum algorithms specifically for derivative pricing and risk analysis, aiming to achieve quantum advantage in core trading operations within this decade. HSBC joined IBM's quantum network to explore applications across fraud detection and regulatory compliance, while Visa is actively researching quantum-resistant security protocols to protect transaction infrastructure. These institutions are not dabbling casually. They are hiring quantum physicists, funding dedicated research teams, and filing quantum-related patents at a rapidly accelerating pace. The message from Wall Street is unmistakably clear. Quantum finance has already begun. That is not just an efficiency upgrade. That is a fundamental transformation of how financial institutions operate within the regulatory landscape. Financial institutions collectively spend hundreds of billions of dollars every single year just to stay compliant with government regulations, reporting requirements, and international financial laws. that is an enormous operational burden. Here is where quantum computing steps in as a genuine game changer. Regulatory datasets are massive, complex, and constantly evolving. Classical computers struggle to process all of this efficiently, which is why compliance teams are enormous and errors are frustratingly common. Quantum computing can analyze regulatory frameworks, cross-reference transaction data, and automatically detect compliance violations at speeds that classical systems simply cannot match. It can generate highly accurate regulatory reports in a fraction of the time currently required. For large banks managing thousands of daily transactions across multiple jurisdictions, this means dramatically reduced compliance costs, fewer human errors, and faster reporting cycles. Now, before you think quantum computing is ready to take over Wall Street tomorrow, let's be completely honest about where things actually stand today. Current quantum hardware is extraordinarily fragile. Qubits are incredibly sensitive to the slightest disturbances, vibrations, temperature fluctuations, even electromagnetic interference can cause errors. Most quantum computers today must operate at temperatures near absolute zero, roughly negative 273 degrees Celsius, colder than outer space itself. That is not exactly plug-and-play technology. This brings us to an important term you need to know, NISQ, which stands for Noisy Intermediate Scale Quantum Devices. These are today's quantum machines, powerful enough to demonstrate potential, but too error-prone and limited in qubit count to reliably run the large-scale financial applications we have been discussing. Experts generally agree we are still somewhere between 5 and 15 years away from fully fault-tolerant quantum computers. And the promise is real, but so are the obstacles standing between today's prototypes and tomorrow's financial revolution. Without closing this talent gap, even the most powerful quantum computers will sit largely underutilized, unable to deliver the financial breakthroughs the industry is desperately counting on. Quantum computing does not just require smart professionals, it requires an entirely new breed of expert. Quantum programmers, quantum algorithm designers, and quantum-aware financial engineers are extraordinarily rare today. We are talking about individuals who must deeply understand quantum mechanics, advanced mathematics, computer science, and financial theory, all at once. That combination barely exists in the current workforce. Most universities only recently began introducing quantum computing into their curricula. Companies like IBM, Google, and Microsoft are now aggressively building educational pipelines, offering online courses, certification programs, research fellowships, and university partnerships, specifically to grow this talent pool before the technology fully matures. IBM's quantum network alone connects hundreds of universities and corporations globally. This technological revolution is not just a corporate competition, it is a full-scale geopolitical arms race with enormous financial consequences. The United States has committed tens of billions of dollars through initiatives like the National Quantum Initiative Act, funding research across government agencies, universities, and private companies simultaneously. China is investing even more aggressively, pouring billions into national quantum laboratories and aiming to achieve quantum supremacy as a cornerstone of its broader economic and military strategy. The European Union launched its quantum flagship program, committing €1 billion to build sovereign quantum capabilities and reduce dependence on American and Chinese technology. Here is why this matters financially. Whichever nation achieves quantum dominance first gains the ability to break enemy encryption, optimize its own financial systems faster than rivals, and potentially manipulate global markets with unprecedented computational power. This is no longer purely a technology story. Quantum computing has become a matter of national security, economic sovereignty, and geopolitical power that will reshape the global financial order entirely. Quantum finance is rewriting the rulebook of how money, risk, and value are understood at their most fundamental level. Researchers and academics are now calling it quantum finance, not just a tool upgrade, but an entirely new discipline. Universities like MIT, Oxford, and institutions like the Santa Fe Institute are building financial models from the ground up using quantum principles, not retrofitting old ones. Think about what that truly means. Classical finance was built on assumptions, normal distributions, linear relationships, simplified risk models. These assumptions existed because classical computers had limits. Quantum computers do not carry those same limits. In a quantum-native financial world, models can embrace full complexity, capturing the true chaotic, non-linear nature of global markets. Researchers are developing quantum versions of the Black-Scholes model, quantum game theory for market behavior, and entirely new frameworks for understanding systemic risk. Before this technology reshapes everything we know about investing, that is the question that truly matters. Here's the uncomfortable truth. Right now, quantum computing access costs millions of dollars. Only the largest banks, hedge funds, and institutional players can afford it. That means the same technology promising faster, smarter, fairer financial decisions could actually deepen the gap between Wall Street and Main Street. Imagine a world where Goldman Sachs optimizes portfolios in real time using quantum algorithms while your retirement fund still runs on decade-old software. That is not a fair market. That is a structural advantage built into the system itself. Regulators are beginning to wake up to this reality. The infrastructure is being built right now, and the destination feels less like speculation and more like inevitability. Today, we are in the early experimental phase. Financial institutions are running quantum pilots, testing algorithms, and building partnerships with quantum hardware providers. Think of it as the 1990s of the internet era. Fast forward 5 years, and quantum advantage in specific financial tasks becomes real. Portfolio optimization, derivatives pricing, and fraud detection will see quantum-powered breakthroughs entering production environments at major banks worldwide. Now imagine 2040. Picture a global financial system where risk is assessed in real time across every market simultaneously. Transactions are secured by quantum cryptography that is mathematically unbreakable. Drop your thoughts below, like this video, and subscribe for more. From portfolio optimization and high-frequency trading to fraud detection, derivatives pricing, and quantum-secured transactions, the applications are real, the opportunities are massive, and the risks are equally serious. The talent gap is real. The geopolitical race is intensifying. The cybersecurity threat is already unfolding right now, not somewhere in the distant future. Here's the truth that every investor, banker, regulator, and curious mind needs to internalize. Quantum computing in finance is not a question of if. It is purely a question of when. The institutions and individuals who understand this shift today, who prepare, adapt, and position themselves ahead of the curve,